$400 billion vanished into an AI investment black hole in 2025. But here's what nobody is telling you. This isn't just another tech bubble. This is the most sophisticated financial engineering scheme in history, and it's built on a house of cards that makes the 2008 mortgage crisis look simple. I've been digging through securities filings, corporate debt structures, and circular financing arrangements, and what I found should terrify anyone who understands how bubbles actually burst. OpenAI just raised $6.6 billion at a $157 billion valuation. The company burns through $7 billion annually while generating $13 billion in revenue. Do the math. They're not profitable. But here's the part that keeps me awake at night. According to Bloomberg data, OpenAI has committed to spending $1.4 trillion over the next 8 years on computing infrastructure. That's more than the entire GDP of most countries. Where is this money coming from? When I trace through the ownership structures and financing arrangements, I discover something that looks eerily familiar to anyone who studied the 2008 financial crisis. We're not just looking at overvaluation, we're looking at systemic interconnectedness that could trigger a cascade failure across the entire global economy when this bubble finally bursts. Let me walk you through the most dangerous financial pattern I've ever analyzed, because understanding this pattern might be the difference between financial survival and catastrophic loss when this house of cards collapses. This is the same 5-stage bubble cycle that has preceded every major financial disaster in modern history, but this time the stakes are exponentially higher. Stage 1. Revolutionary narrative. A new technology emerges that promises to change everything. Early adopters make extraordinary returns. Media coverage explodes. Everyone wants in. In the 1990s, it was the internet. In the 2000s, it was housing. Today, it's artificial intelligence. Stage 2. Financial engineering. Smart money figures out how to package and sell the narrative to institutional investors. Complex financial instruments emerge. Risk gets distributed and hidden. Leverage multiplies. This is where we are right now with AI. Stage 3. Circular financing. Companies start investing in each other. Revenue becomes indistinguishable from financing. Balance sheets become impossible to analyze. Valuations lose any connection to fundamental economics. Stage 4. Warning signs. Insiders start selling. Media coverage turns skeptical. Regulatory scrutiny increases. But the momentum is too powerful to stop immediately. Stage 5. Catastrophic unwinding. One major player fails. Credit markets freeze. The interconnected web of circular financing collapses simultaneously. Everyone discovers that the emperor has no clothes. Here's why this AI bubble is different and exponentially more dangerous than anything we've seen before. In the dot-com bubble, most companies were burning venture capital and had minimal revenue. When they failed, the damage was contained to equity markets. In the housing bubble, the leverage was primarily in mortgages backed by real assets. The AI bubble is different because it's built on corporate debt, government contracts, and cross-ownership structures that touch every major financial institution in the world. When this unravels, it won't just affect tech stocks. It will affect pension funds, sovereign wealth funds, and the balance sheets of the largest corporations and banks globally. Let me show you exactly how this circular financing scheme works, because once you see the pattern, you can't unsee it. Microsoft invested $13 billion in OpenAI and owns approximately 49% of the company. But Microsoft is also OpenAI's largest customer, accounting for nearly 40% of their revenue through Azure Cloud Services. OpenAI uses that revenue to buy computing power from Microsoft Azure. But it gets more complex. Nvidia has invested $100 million in CoreWeave, an AI cloud computing company. OpenAI has committed $60 billion over 5 years to rent computing capacity from CoreWeave. But here's the circular part. OpenAI is paying CoreWeave partially in equity, and CoreWeave is using that equity as collateral to buy more Nvidia chips. Nvidia has also guaranteed to purchase any unused CoreWeave capacity through 2032. Now add Oracle to the mix. Oracle has committed $300 billion in computing infrastructure deals with OpenAI over the next 5 years. But Oracle doesn't manufacture the chips. They buy them from Nvidia. And Oracle is financing this expansion partially through debt backed by expected future AI revenues. Meanwhile, Amazon has invested $4 billion in Anthropic while becoming their primary cloud provider. Google has invested $2 billion in Anthropic while competing with them in the AI market. Meta has announced $35 billion in AI infrastructure spending in 2025 alone, much of it going to the same network of suppliers and partners. Do you see the problem? This is not a market, it's a closed-loop financial engineering scheme where the same dollars are cycling through the same companies, creating the illusion of massive demand and revenue growth. When I map out these relationships, it looks exactly like the synthetic CDO structures that destroyed the global financial system in 2008. But here's where it gets truly terrifying. According to Morgan Stanley's analysis, big tech companies will need to raise approximately $1.5 trillion in additional financing through 2028 to meet their AI infrastructure commitments. Their current cash flows can only cover about half of their announced spending plans. This means they're betting everything on future AI revenues that don't exist yet. The debt structures are even more dangerous than the equity valuations. Meta has issued $47 billion in corporate bonds since 2023, much of it to finance AI data centers through special-purpose vehicles that can be offloaded if the AI boom fails. Microsoft has $78 billion outstanding debt, up from $34 billion in 2020, with most of the increase tied to AI infrastructure investments. But here's the part that should terrify regulators. These aren't just corporate balance sheet problems. According to Federal Reserve data, U.S. pension funds have increased their exposure to AI-related assets by 340% since 2023. Sovereign wealth funds from Norway, Singapore, and the Middle East have committed over $200 billion to AI investments. Insurance companies have allocated approximately 15% of their investment portfolios to AI and tech growth stocks. When this bubble bursts, and it will burst, it won't just affect Silicon Valley tech workers, it will affect retirees whose pension funds are overexposed to AI stocks. It will affect insurance policyholders whose insurance companies can't meet their obligations. It will affect taxpayers whose government pension systems bought into the AI narrative at peak valuations. The warning signs are already flashing red for anyone paying attention. Peter Thiel, one of the most successful technology investors in history, sold his entire $100 million Nvidia stake in November 2025. SoftBank, which had been one of the most aggressive AI investors, sold nearly $6 billion worth of Nvidia shares. Michael Burry, who predicted the 2008 housing crash, has reportedly taken short positions against several major AI companies. But perhaps most telling, MIT released a study in July 2025 showing that 95% of companies that invested in generative AI are seeing zero return on their investment. Zero. Despite spending an estimated $40 billion on AI implementation, the vast majority of corporate AI projects have failed to produce any measurable productivity gains or cost savings, yet the stock prices keep rising. Nvidia has gained over 180% in 2025, despite the fact that their actual chip sales growth has slowed to 12% year over year. OpenAI's valuation has tripled in 18 months, despite burning through cash faster than any startup in history. The disconnect between fundamental economics and financial valuations has reached levels that make the dot-com bubble look conservative. Here's what's really driving the valuations, and it has nothing to do with actual artificial intelligence capabilities. According to Securities and Exchange Commission filings, the largest AI companies are using what's called revenue backlog to justify their valuations. They're booking future contracted revenue as current assets, even though most of these contracts are with companies they're also investing in or lending money to. CoreWeave reported a $55.6 billion revenue backlog in their most recent earnings call. But when you examine the contracts, 78% of that backlog is from companies that CoreWeave has financial relationships with. Oracle reported a $455 billion AI revenue backlog, but most of those contracts are structured as complex financing arrangements rather than traditional service agreements. This is exactly how Enron justified their valuations in 2001. They were booking revenue from special-purpose entities that they were also financing. When the financing dried up, the revenue disappeared, and the company collapsed overnight. The AI industry has created the same structure, but scaled up by a factor of 100. The energy requirements alone should be enough to collapse this bubble. According to the International Energy Agency, AI data centers currently consume approximately 1.3% of global electricity. If AI adoption continues at its current pace, AI data centers will consume 8.5% of global electricity by 2030. That's more electricity than the entire continent of Africa currently uses. The power grid can't handle this demand. In Virginia, which hosts approximately 70% of the world's internet traffic, data center electricity demand is projected to increase by 85% by 2028. The State Utility Commission has warned that without massive infrastructure investment, rolling blackouts are inevitable. Similar warnings have been issued in Ireland, Singapore, and the Netherlands. But here's the truly insane part. The AI companies have signed power purchase agreements for electricity that doesn't exist yet. From power plants that haven't been built yet, using financing that depends on AI revenues that haven't been generated yet. It's a three-way circular dependency where each leg depends on the other two, and none of them have solid foundations. Microsoft has committed to purchase 10.5 gigawatts of clean energy by 2030 to power their AI operations. That's more than the total electricity generation capacity of most U.S. states. Google has signed contracts for 8.3 gigawatts of renewable energy for their AI data centers. Amazon has committed to 6.7 gigawatts. Where is this electricity supposed to come from? The answer is debt financing, backed by projected AI revenues. Utility companies are issuing billions in bonds to build power plants that will sell electricity to AI companies that are financing their operations with debt, backed by future revenues from AI services that may never be profitable. It's the most complex circular financing scheme in human history. Meanwhile, the technology itself is hitting fundamental limitations that the financial markets haven't recognized yet. According to OpenAI's own research papers, the rate of improvement in large language models has plateaued. The latest models require exponentially more computing power to achieve marginally better results. This is called the scaling wall, and it suggests that we may be approaching the physical limits of current AI architectures. Anthropic CEO Dario Amodei admitted in a recent interview that his company is hitting diminishing returns on model improvements. Google's DeepMind has acknowledged that their latest models are becoming prohibitively expensive to train and operate. Even Sam Altman has stated publicly that the current approach to AI development is not sustainable. Yet somehow, investors continue pouring money into companies that are openly admitting their core technology is approaching fundamental limitations. This is not rational market behavior. This is bubble psychology at its most extreme. The regulatory response is also accelerating. The European Union's AI Act went into full effect in August 2025, imposing significant compliance costs on AI companies operating in Europe. The Federal Trade Commission has opened antitrust investigations into Microsoft, Google, and OpenAI's cross-ownership structures. The Securities and Exchange Commission is requiring enhanced disclosure of AI-related investments and revenue recognition practices. But perhaps most concerning, central banks are starting to worry about systemic risk. The Bank for International Settlements issued a warning in September 2025 about excessive concentration of AI investments and the potential for coordinated selling pressure if AI valuations correct rapidly. The Federal Reserve's Financial Stability Report mentioned AI bubble risks for the first time in November 2025. When central banks start worrying about asset bubbles, it usually means the bubble is in its final stage. Central bankers are notoriously behind the curve on identifying bubbles, so when they start issuing warnings, smart money has usually already started heading for the exits. The unwinding has already begun in some corners of the market. Venture capital funding for AI startups declined 23% in the third quarter of 2025 compared to the second quarter. Initial public offerings of AI companies have been postponed or canceled due to market conditions. Private equity firms have started marking down the value of their AI portfolio companies. But the most telling indicator is in the options market. Put option volume on major AI stocks has increased by 340% since October 2025, Sophisticated institutional investors are quietly hedging their AI exposure, even as their public statements remain bullish. This is exactly what happened in early 2000 before the dot-com crash and in 2007 before the housing crisis. Here's what I think happens next, based on the historical pattern of financial bubbles and the specific vulnerabilities I've identified in the AI ecosystem. The catalyst will likely be a major AI company failing to meet a debt payment or defaulting on a major contract. Given the circular financing structures, this will immediately create counterparty risk for every other major player. Within 48 hours of the initial default, credit markets will freeze for AI-related corporate debt. Companies that need to roll over billions in financing will find themselves unable to access capital markets. Stock prices will gap down 30 to 50% in a single session as algorithmic trading systems and passive index funds are forced to sell. The second wave will hit pension funds and insurance companies that are overexposed to AI investments. Forced selling will accelerate the price decline and create liquidity crises in previously stable financial institutions. Government bailouts will be politically impossible given the speculative nature of AI investments. The third wave will be international contagion. European and Asian financial institutions with AI exposure will face funding crises. Currency markets will destabilize as investors flee to safety. Central banks will be forced to choose between defending their currencies and providing domestic liquidity support. By the time the dust settles, I estimate that total losses could exceed $2 trillion globally. That's larger than the GDP of most countries and comparable to the total losses from the 2008 financial crisis. But unlike 2008, where losses were primarily concentrated in mortgage-related assets, AI bubble losses will be distributed across equity markets, corporate debt, pension funds, and sovereign wealth funds globally. The irony is that artificial intelligence will eventually be transformative, just like the Internet eventually transformed the global economy after the dot-com crash. But first, we have to survive the financial destruction caused by irrational speculation and circular financing schemes that have disconnected AI valuations from economic reality. So here's my question for you. When the AI bubble bursts, when circular financing schemes collapse, when pension funds announce massive losses, when governments are forced to choose between bailing out speculative AI investments or protecting essential services, which side of that trade do you want to be on? The $400 billion AI deception isn't just about technology companies. It's about a financial system that has learned nothing from previous bubbles and has created the most dangerous speculative mania in human history. The signs are all there for those willing to see them. The question is whether you'll recognize the pattern before everyone else does. This is not investment advice. This analysis is based on publicly available financial data and represents my interpretation of market dynamics and regulatory filings. Always consult qualified professionals before making investment decisions.